$175,000. David is staring at that number in his brokerage app, sitting in a parking garage beneath his office building. Engine still running. He hasn't gone inside yet. He has been looking at this number for about 10 minutes, and the feeling in his chest is not pride. It is not relief. It is something closer to quiet dread. He is 34 years old. He earns $180,000 a year as a director at a technology firm. He has been investing $2,500 every single month for 5 years without missing once. He skipped vacations. He drives a 4-year-old car. He does everything the personal finance books told him to do. And the number is $175,000. Meanwhile, his colleague Ryan just put a down payment on a $1.2 million house in the suburbs. Another peer keeps casually mentioning his stake in a startup. And David, the one who actually built the spreadsheet, who actually ran the math, has $175,000 and a feeling he cannot name. That feeling has a name. And by the time you finish this, you will understand exactly what it is, where it comes from, and how it ends. More specifically, you will stop confusing income with wealth. And that one reframe will permanently change every financial decision you make from this point forward. Because here is what no one tells you. Earning $150,000 a year does not make you wealthy. It makes your financial mistakes more expensive. A high income without a specific framework doesn't accelerate wealth. It accelerates the illusion of wealth. And that illusion, unrecognized, will quietly cost you the next 20 years. David doesn't know it yet, but he is standing right at the edge of something. He hasn't crossed what I call the acceleration threshold. The point where compounding stops feeling like patience and starts feeling like power. He is doing the right things. He just doesn't have the right framework. And the framework that will change everything is called the 7531 matrix. 4 numbers, 4 layers. Let's walk through all of them. The first number is 7. When high earners get serious about investing, they bring the same intensity that made them successful in their careers and aim it directly at their portfolio. They check it every week. They compare this month to last month the way they track quarterly performance reviews. They expect the market to reward hard work and focused attention. The market does not care about your title. It does not reward intensity of attention. It does not know that you got promoted twice in 3 years. Here is a fact about market history that almost nobody discusses with the weight it deserves. If you take any random 12-month window in the history of the stock market, the probability that your investment ends higher than it started is roughly 51%, barely better than a coin flip. You could invest $50,000, check it a year later, and have a legitimate mathematical chance of seeing less than you put in. Not because you did anything wrong, but because 1 year simply is not enough time. Now stretch that window to 7 years. Any random 7-year period in more than a century of United States market history pushes the probability of a positive return to nearly 100%. Every crash, every recession, every financial crisis, the 7-year window has absorbed them all and still ended higher. 7 years is not a suggestion. It is what the data shows. The volatility that frightens you in year 1 and year 2 is not a sign that something is broken. It is the price you pay for the returns that wait on the other side. Most high-income professionals never collect those returns because they cannot stay still long enough. Think of it this way. Nobody buys a commercial building in a major city and then calls their agent 6 months later in a panic because of a temporary vacancy. Nobody walks through a skyscraper under construction and says, "This doesn't look finished yet. I want out." But that is exactly what investors do with their portfolios. They evaluate a 20-year wealth machine against a 12-month window, feel disappointed, and make changes. Those changes do not improve the outcome. They destroy it. David is not doing anything wrong. He is evaluating the right thing on the wrong timeline. His portfolio is not a performance review. It is a building under construction. The foundation is solid. What he needs is to stop walking through the site with a stopwatch. The second number is 5. High earners make a specific mistake that lower earners almost never make. They concentrate. If you are a director at a technology company, a significant portion of your compensation probably comes as company stock, restricted stock units, long-term incentive grants, employee stock purchase plans. All of it tied to the same company that pays your salary and controls whether you have a job next year. When the market turns, you don't just lose portfolio value. You risk losing your income and your savings at the same time because they are made of the same thing. That is not diversification. That is concentrated exposure wearing the costume of a benefits package. A resilient portfolio at David's income level needs 5 distinct pillars. The first pillar is broad market index funds, the boring anchor that owns the entire market, capturing the winners automatically, 40 to 50%. The second pillar is dividend-paying stocks from companies that have raised their dividends consistently for decades. When the market is red and your balance is falling, you are still receiving cash deposits every quarter. That cash, arriving regardless of what the market is doing, is the most underestimated force in long-term investing psychology. It keeps you in the game when every instinct says to get out, 10 to 15%. The third pillar is smaller and mid-sized company stocks. The aggressive growth engine, volatile in the short term, but capable of growing tenfold over 15 years, 10 to 15%. The fourth pillar is international equities. Because the United States will not always be the dominant market story, and owning global companies protects you if American returns slow during the exact decade when your compounding needs to accelerate. 10 to 20%, the fifth pillar, and this is the one almost nobody talks about at high income levels, is tax-protected instruments. Municipal bonds, treasury arrangements, accounts structured to shelter gains from the tax bracket you are already in. At $180,000 a year, the government takes a significant slice of every investment gain before it compounds. A tax-exempt instrument that yields slightly less on paper can yield more in your actual account than a higher-rate taxable instrument. The gap is invisible until you calculate it. At your income level, that gap is large enough to meaningfully change your outcome over 20 years, 10 to 20% here. When David restructures his portfolio from 60% employer stock into these 5 pillars, he changes not just his risk profile. He changes the emotional experience of being an investor. Because different pillars behave differently in different market conditions, and the whole thing becomes something you can actually live with. And you will need to be able to live with it. Because the third number is the hardest one. The third number is 3. Between the beginning of a disciplined investment strategy and the finish line, there are 3 specific emotional traps waiting. They are not random. They are predictable, and they are especially dangerous for high earners because of the specific environment a high income creates. The first trap arrives in years 1 through 3. The portfolio is still small enough to feel irrelevant, and the world around you keeps producing evidence of faster paths. A colleague puts 20% of a bonus into a startup that triples. A friend makes $400,000 flipping a property with borrowed money. You see the new car in the parking garage, the lake house photographs, the casual mention of an angel investing round. And something deeply uncomfortable starts forming in your chest. The feeling that your approach, the boring disciplined index fund approach, is the coward's path. That the people taking bigger risks are getting bigger rewards. This feeling is not weakness. It is the predictable output of your environment. The colleague who tripled his money also knows 3 people who lost everything on similar bets and never mentions them. You are watching a highlight reel and comparing it to your behind-the-scenes footage. The second trap is quieter and, in some ways, more damaging. It arrives in years 4 and 5, when you have put more than $100,000 of your own earned money into the market, and the market has done nothing for 18 months. Flat. Sideways. You have made real sacrifices. The vacation you didn't take, the renovation you delayed, and the number on the screen barely moved. It feels like the math lied to you. I call this the slog. It is the phase where disciplined investors quit, not because something went wrong, because nothing went visibly right on the timeline they expected. The compounding curve is slow early and explosive later. You are on the flat part, unable to see the bend coming, and quitting here, redirecting that money, cashing out, permanently removes you from the acceleration that was weeks or months away. The third trap is the most dramatic and the most viscerally painful for someone at David's income level. It is the real crash, not a bad month. A sustained, aggressive collapse. The kind that happened in 2022 when technology stocks lost 30 to 40% of their value in under a year, and carefully built portfolios showed 5-figure losses in a single week. Here is why this is uniquely brutal for high earners. When a portfolio worth $600,000 drops by $60,000 in 1 month, your brain does not register a percentage. It registers $60,000, a car, a year of rent, something you can picture losing. The instinct is to move to cash, to wait until things stabilize, to re-enter at the right moment. This instinct is not stupidity, it is biology. But acting on it here is not protection. It is permanent destruction. You do not just lose the value you lost, you lose the recovery. You lock in the loss, then watch from the outside as the market climbs back past where it was, unable to find the perfect moment to get back in because that moment never announces itself clearly. The people who held through 2022 without selling are, right now, sitting on portfolios that fully recovered and climbed past their previous highs. The people who sold in the panic are still doing the math on what that cost them. All 3 traps, the status envy, the slog, the crash panic, are defeated by a single decision made in advance. Decide right now, before the emotional weather of a market event distorts your thinking, that your portfolio is locked for 7 years minimum. Not legally locked, psychologically locked. When the pressure comes, you do not make the decision again. You simply remember the one you already made. The 4th number is 1. David is contributing $2,500 a month. If he keeps doing exactly that for 20 years at a historically average market return, he ends up with a genuinely good outcome. Real security. A comfortable retirement. But if David makes one single change to that strategy, just one, the final number practically doubles. Every year, when his annual salary review happens and his bonus arrives, David takes 50% of the income increase and automatically redirects it into his investment accounts before it touches his checking account. He never sees it. It never becomes part of his baseline. His contribution grows from $2,500 a month to $3,000, then to $3,750, then climbing quietly and automatically across a decade of career progression. That single habit converts a good retirement into something else entirely. Instead of arriving at $1.6 million at 60, David crosses $2.5 million at 50. The difference is not risk. It is not a better stock pick. It is the decision to capture a portion of each raise before the brain normalizes it as spending money. I call this raise harvesting. And it works not because it is aggressive, but because it defeats the most dangerous force in the financial life of a high earner, which is not market volatility, not bad picks, but lifestyle creep. The automatic, invisible expansion of your standard of living to fill every dollar of every raise you ever receive, leaving you permanently at the same level of financial pressure, regardless of how much more you earn. Raise harvesting interrupts that mechanism at the source. It converts income growth into wealth growth before the lifestyle has the chance to absorb it. Now let's see both outcomes side by side. David applies the 7-5-3-1 matrix. He restructures across 5 pillars. He locks the 7-year frame mentally. He survives 3 years of watching colleagues appear to get rich faster than him. He survives 18 months of sideways markets without redirecting a dollar. When the crash arrives and his portfolio drops $70,000 in 6 weeks, he does not sell. The decision was already made. He keeps automating, capturing each raise before it becomes lifestyle, watching the monthly contributions grow year after year. At 50, David opens the same brokerage app he sat staring at in that parking garage 16 years earlier. The number on the screen is $2.5 million. His portfolio is now generating roughly $80,000 to $90,000 per year in income on its own, more than many full-time salaries. He can stay in his career because he wants to, or he can leave. For the first time in his adult life, the choice is actually his. Now meet Marcus. Marcus is 34, earns $180,000 a year, and starts from the exact same position as David. But when the market pulls back in year 4, and his portfolio is down to $80,000 after depositing over $100,000, Marcus cashes out. He uses the proceeds toward a house that is slightly larger than he needs, in a neighborhood slightly more expensive than is comfortable. The following year, a friend's enthusiasm for a software stock convinces him to put $30,000 into a company that will lose 70% of its value in the next contraction. His annual bonuses arrive and become vacations, renovations, and a car payment that feels completely reasonable given what he earns. At 50, Marcus has a beautiful home with 14 years left on the mortgage. He has almost no invested assets. He earns more than he ever has, and spends slightly more than he earns. The gap between his income and his freedom has not closed. It has widened, quietly, one sensible decision at a time. Marcus is not foolish. He is not reckless. He is the entirely predictable output of a system that was never designed to make him free, only productive. The difference between David at 50 and Marcus at 50 is not talent. It is not luck. It is not even the original income, because they had the same one. The only difference is whether they understood the acceleration threshold and built a structure that would carry them across it without requiring heroic willpower every single month. Once you see this clearly, you cannot unsee it. And the actions that follow are not a checklist. They are the natural, obvious extension of finally understanding what is actually happening. Open your brokerage account today, not to check the return, but to check the composition. If more than 20% of your total invested assets are tied to your employer's stock, you are carrying concentrated risk that belongs to your employer more than it belongs to your future. Begin restructuring gradually toward the 5 pillars. Then go into your payroll system and find the field that controls your contribution or direct deposit. Set it so that 50% of your next salary increase is automatically redirected to your investment account before you ever see it. You will not miss money you never touched, but 10 years from now, you will feel the full compounded weight of that decision. And then do the hardest thing, which costs nothing. Decide right now, in the clarity of this present moment, before any crash or market panic distorts your thinking, that your portfolio is untouchable for 7 years. Not negotiable, not unless things get really bad. Untouchable. Make that decision once clearly and let it stand in for every future moment of doubt. Compounding is the ultimate filter. It separates the people who look wealthy on social media from the people who actually are wealthy on paper. Not because the people who look wealthy are dishonest. But because the appearance of wealth is available to anyone with a high enough income and a willingness to spend it, actual wealth, the kind that generates income while you sleep, that survives crashes, and still arrives at an exponentially larger number 15 years later, that is only available to the people who understood the mechanism and refused to interrupt it. The number on your screen right now is not a verdict. It is a foundation. And what you build on it, and how long you refuse to let fear tear it down, is the only thing that has ever mattered. I will see you in the next one. And by the time that one ends, you will know precisely how to calculate the single number that actually determines your financial freedom. It is not your salary. It is not your net worth. It is something most people never think to measure.